In the accounting cycle, once transactions have been recorded and adjustments have been made, the next step is to report the financial results of the business. Financial statements summarize the financial performance of a company and help managers, investors, and creditors understand how the business is performing. Your bank can freeze your account anytime without your permission. The first step in the accounting cycle is recording financial transactions through journal entries using the double entry accounting system. After transactions are recorded in the journal, they are transferred to the ledger where each account balance is updated. After transactions are posted to the ledger, accountants prepare a trial balance to verify that total debits equal total credits. Before preparing financial statements, adjusting entries are recorded to ensure that revenues and expenses are recognized in the correct accounting period. After adjusting entries are recorded, the adjusted trial balance is prepared. This trial balance becomes the starting point for preparing financial statements. Using the adjusted trial balance, accountants prepare the main financial statements that summarize the company's financial performance and position. The income statement reports the revenues and expenses of a company during a specific period and shows whether the business earned a profit or incurred a loss. Revenues represent the income earned by a business from its normal operations, such as selling products or providing services. Expenses represent the costs a company incurs in order to generate revenue and operate its business activities. Net income is calculated by subtracting total expenses from total revenues, showing whether the company earned a profit during the period. The statement of retained earnings explains how the retained earnings balance changes during the accounting period. It starts with the beginning balance, adds net income, and subtracts dividends to find the ending balance. Dividends represent the distribution of profits to shareholders and reduce the retained earnings balance of a company. Assets represent the economic resources owned by a company that are expected to provide future benefits. Liabilities represent the obligations a company owes to creditors and must repay in the future. Stockholders' equity represents the owner's claim on the assets of the company after all liabilities have been paid. The accounting equation shows that assets must always equal the sum of liabilities and stockholders' equity. The statement of cash flows explains how cash moves into and out of a business during an accounting period.
Operating activities include cash transactions related to the primary operations of the business, such as receiving payments from customers.
Investing activities involve the purchase or sale of long-term assets such as equipment, buildings, or investments. Financing activities involve obtaining funds from investors or creditors and repaying those obligations. Cash inflows occur when a company borrows money or receives investments from shareholders. The statement of cash flows helps users understand how a company generates and uses cash during a specific period. This information is crucial for assessing a company's liquidity, financial flexibility, and overall financial health. Financial statements are often accompanied by notes that provide additional explanations and important details about the reported numbers. Notes to financial statements provide essential context that helps users better understand the numbers presented in the reports. The closing process is the final step in the accounting cycle. The purpose of closing is to reset temporary accounts for the next accounting period. Only temporary accounts are closed, while permanent accounts continue into the next period. Temporary accounts include revenues, expenses, and dividends. The closing process follows a specific sequence to ensure accurate financial reporting. First, revenue and expense account balances are transferred to the income summary account, and dividends are closed to revenue accounts are closed by transferring their balances to the income summary. The first step in closing entries is to close all revenue accounts. Revenue balances are transferred to the income summary account. The closing entry for revenue is revenue account debit and income summary account credit.
After closing, revenue accounts have a zero balance.
Next, all expense accounts are closed. Expense balances are transferred to the income summary account. The journal entry is income summary debit and expenses account credit. After closing, expense accounts also have zero balances. The income summary account collects revenues and expenses to calculate net income. The difference between revenues and expenses determines net income or loss.
The income summary balance is transferred to retained earnings.
The journal entry is income summary debit and retained earnings credit. The next step is to close the dividends account to retained earnings. The journal entry is retained earnings debit and dividends account credit. After closing, the dividends account also becomes zero. After all closing entries, we prepare the after-closing trial balance. This trial balance includes only permanent accounts such as assets, liabilities, and equity. This trial balance includes only permanent accounts such as assets, liabilities, and equity. Financial statements provide valuable information that allows managers and investors to evaluate the financial performance of a business. Profitability ratios help evaluate how effectively a company generates profit relative to its sales or assets. Profitability ratios help evaluate how effectively a company generates profit relative to its sales or assets. For example, the profit margin measures net income against sales, return on assets relative to total investments. Many companies prepare interim financial statements such as monthly or quarterly reports to monitor performance during the year. Profit margin measures how much profit a company generates from its sales revenue. Return on equity measures how effectively a company uses shareholders' investments to generate profit. Return on equity measures how effectively a company uses shareholders' investments to generate profit. Working capital is the difference between current assets and current liabilities and reflects short-term financial flexibility. For example, with $150,000 in current assets, financial ratios are often compared with industry benchmarks to evaluate how well a company is performing. Trend analysis helps analysts evaluate how financial performance changes across several accounting periods. Comparative financial statements allow users to analyze financial changes by presenting results from multiple periods side by side. These reports show a 15% revenue increase. We need to reinvest in marketing. The margins are solid, but let's check cash flow.
Cash flow is positive, but operating adjust the budget. We'll review next week.
Accurate financial reporting is essential for maintaining trust among investors, creditors, and other stakeholders. With the financial statements prepared, analysts can now perform deeper evaluations of a company's performance and financial health. Financial analysis helps evaluate a company's performance and financial condition. Revenue growth shows how a company's sales increase over time.
Managing expenses effectively helps businesses maintain profitability.
Cost control allows businesses to improve efficiency and increase profits. Profit trends reveal whether a company is improving its financial performance over time. Asset utilization measures how efficiently a company uses its resources to generate revenue. Inventory turnover shows how quickly a company sells and replaces its inventory. Accounts receivable analysis helps companies manage customer payments effectively. This dashboard visualizes aging goals. Businesses can itemize and act on overdue accounts.
Financial forecasting helps businesses plan future growth and investment decisions. Budget planning helps organizations allocate financial resources efficiently.